All right, let's dive right in. Today, we're unpacking exactly why relying purely on South African domestic assets is, frankly, a dated strategy, and how capital is structurally rotating toward the broader SADC region. We're going to be digging into a really fascinating framework from the Khumo Solutions Global Macro Desk. They make a compelling case that South Africa's domestic growth is capped by some pretty hard structural constraints, and because of that, economic power has been steadily migrating outward. If you want to know exactly where institutional growth capital is moving between now and 2030, you're in the right place. Let's get into this explainer.
Our roadmap for today covers 5 key areas. We'll start with moving beyond the domestic anchor, then redefine our capital allocation risks, talk about how to hedge the transition, map out the actual 2026 to 2030 rotation plan, and finally, look at the catalysts coming from SADC and the SARB.
Section 1. Beyond the domestic anchor. We've got to start by tearing down this illusion that South Africa just functions as a self-contained macro story.
For years, investors could get most of their Africa exposure simply by buying JSE-listed companies and calling it a day. But that framing, it's officially retired. The reality is that since 2015, economic power has steadily shifted toward places like Tanzania, Zambia, Mozambique, and the DRC. Why? Well, it's a massive combination of surging global demand for critical minerals. We're talking copper, cobalt, lithium for the energy transition, alongside some intense demographic momentum. These countries are urbanizing from a lower base with much younger populations, which basically implies a much longer runway for formal retail, banking, and telecoms growth, especially when you compare it to South Africa's sub-2% growth trend.
Section 2. Redefining capital allocation risks. To really understand why domestic growth is capped, we have to completely redefine the structural constraints that act as our new baseline risks.
The big institutional analysts out there are now treating water efficiency and logistical reliability as absolute first-order capital allocation metrics. These aren't just ESG footnotes anymore. Take water scarcity. It literally forces companies to redirect their growth capital into alternative sourcing, like drilling boreholes or setting up desalination plants, which introduces serious regulatory risks, especially in water-stressed areas. And on the logistics front, Transnet's port and rail constraints act like an unpredictable, variable tax on literally any business dependent on imports or exports. If a company relies on a single transport corridor right now, they should absolutely be discounted compared to a competitor with multimodal road and rail optionality.
Now, the government is making moves, of course. Operation Vundenlela recently set up the National Water Crisis Committee, Watercom, to coordinate a response. But let's be real, a government decree doesn't magically make water flow from a dry tap. The macro desk's ruling on this is totally clear. This is an active but largely unproven institutional response. Even with the National Water Action Plan in play, this risk discount remains firmly in place until we see measurable outputs. You just can't remove a structural risk from your forecasts based on a press release.
Section 3. Hedging the transition. So the million-dollar question is, how do we actually defend a portfolio while these domestic constraints bite and we're prepping to rotate capital?
We have to talk about the ultimate domestic constraint coming out of the 2026 national budget. Debt service now consumes roughly 16% of total government expenditure. Just think about the sheer scale of that. It creates a hard, unforgiving fiscal ceiling on counter-cyclical spending. If the economy stumbles, the government simply doesn't have the fiscal space to spend its way out, because every single basis point increase in long-term yields eats directly into the budget. This is exactly why regional diversification isn't just a nice-to-have option anymore. It is a totally necessary hedge against South Africa's fiscal stress.
To hedge against oil-driven structural inflation, we can use Sasol as a brilliant synthetic offset. It's one of the very few companies that benefits directly from the exact global shock that crushes domestic consumers. Because Sasol uses domestic coal and gas to produce synthetic fuels, which are priced against global oil benchmarks, a spike in Brent crude mechanically boosts their revenue without them having to import expensive oil. So if your portfolio is bleeding because high fuel prices are crushing retail margins, holding Sasol provides this incredibly natural internal offset.
We're also seeing a really clear contrast in how major JSE players are managing cost pressures. Look at FirstRand. They leverage their balance sheet and regional reach. They're leaning hard on expanding interest margins and earnings from African operations outside South Africa that simply aren't tied to the local reserve bank's policy. Then you've got ShopRite. using massive operational scale. They defend against inflation by negotiating aggressively with suppliers, pushing their value private labels like USave and Boxer, and leveraging that incredible fixed-cost 60/60 delivery ecosystem to retain customers. Those are two completely different, yet highly effective ways to survive a high inflation cycle.
Section 4, the 2026 to 2030 rotation plan. Let's move to the execution phase. This is where the rubber meets the road and the Iron Prescription's playbook for SADC expansion.
The target for institutional portfolios is to phase 8 to 15% of growth capital into regional proxies. We want to capture those expanding consumer and resource markets. To be clear, this isn't about entirely abandoning the domestic market. Domestic JSE financials are still the liquidity core, but it is about being highly deliberate. You take that 8 to 15% slice and you direct it straight toward the faster-growing economies in the SADC region to genuinely diversify your risk.
The timeline maps out a very precise four-step strategy. Phase 1 in 2026 starts safely with existing JSE proxies, names you know, like Standard Bank, ShopRite, and MTN, companies already operating regionally. Then, in 2027, Phase 2 introduces selective direct exposure to Zambia and DRC copper miners, right as the critical minerals supercycle matures. Phase 3 in 2028 evaluates Mozambique LNG, but that is strictly if the security situation in Cabo Delgado is fully resolved. And finally, Phase 4 in 2029 and 2030 aims to reach that full 15% allocation, assuming all the previous signals give us a green light.
But keep in mind, this rotation is heavily conditional. Every single phase only unlocks based on specific macroeconomic triggers and governance signals. It is absolutely not driven by a fixed calendar. For example, the desk is currently operating under a de-escalation watch regime, meaning Brent crude and the dollar-rand exchange rate have finally cooled off from their recent crisis peaks. That cooling gives us a really rare window with lower volatility to actually execute these capital rotations cheaply. If geopolitical tensions flare up again, the rotation pauses. Simple as that.
Section 5. Catalysts from SADC and the SARB. What are the immediate, near-term catalysts that will dictate whether we hit the gas or hit the brakes on this strategy?
With South Africa taking the SADC Chairship at the 46th Summit in Durban, we are hunting for hard commitments on critical minerals transformation, not just ambitious, empty rhetoric. The summit's agenda lines up perfectly with the Phase 2 rotation trigger. But, as the Iron Prescription explicitly notes, we treat their communique as a governance signal input, not an immediate buy signal. We all know SADC summits are famous for these grand themes. What we actually care about are binding financing commitments and concrete cross-border infrastructure mechanisms.
Simultaneously, the South African Reserve Bank's path is proving to be incredibly volatile. This is definitely not the smooth glide path to rate cuts some people were hoping for. We saw a 25 basis point hike in May, followed by a very tense, divided 4-2 hold in July, even while consumer inflation ticked up to 5%. The governor has explicitly warned everyone about upside inflation risks, and that makes the upcoming September Monetary Policy Committee meeting a hard, non-negotiable checkpoint for our entire allocation model.
Which leaves us with a pretty critical question to monitor as the data keeps rolling in. Will September's inflation data tip that volatile SARB split into a defensive hike and basically slam the window shut on this low volatility rotation? The macro landscape is shifting fast, you guys, and the capital is definitively moving north. The only real question left is, will your portfolio be properly positioned for the ride, or are you going to be left waiting on the platform at a broken station?